We're green across the board as stocks continue to extend their rebound from the deep-seek sell-off earlier in the week. And by the way, yesterday's post-Fed sell-off as well. Has it created a buying opportunity? That's what our next guest is wondering. And outside the tech sector, joining me now is Rich Saperstein of Treasury Partners. Good to see you again.
Likewise.
So you've liked mega cap for a long time. Even when you were negative on the market, you were kind of hiding out in munis and cash and in the mega caps. Has any of your view changed as a result of the events of this week?
Not at all. In fact, it creates opportunity to add. Look, if the cost of training these AI models goes down, it'll only increase adoption and search, right? So that adds benefit to large cap tech and utilities because large cap tech now will have a lower CapEx cost going forward. So it becomes more efficient, and in the power sector, there's just tremendous opportunity right now.
What if you just need less power to deal with all of this? If you don't need the most expensive and most powerful chips, maybe you don't need the most power that you thought you did as well.
That's where the market's getting it wrong, because 60% of the future power needs are actually going to come from non-AI related consumption, meaning electrification, onshoring of new factories, electric vehicles. So that portion from AI is going to actually increase because adoption will increase. They'll still need Blackwell chips. And listen, if you listen to the Microsoft call, they said, what are you constrained in? It's not only GPUs, it's power. And this is where the opportunity is that the market has missed this week.
So if anything, you would look at some of the sell-off and buy it rather than get overly worried and sort of move out of any of these names.
Well, take Vistra, VST.
Yeah, you've been in that a long time. That's a utility that last year was one of the best performing stocks in the S&P 500. It was up like 400%.
Okay.
Or something to that degree. That story hasn't changed at all?
So we bought the stock initially in 2021 in the 20s, and it went up to 200 last week. It was up 8 times, and it came down about 30%. Now, the cash flow is still 12% operating cash flow. There's tremendous opportunity in announcements they can make. And that opportunity in Vistra is still there, and we added it to it earlier this week after it came down.
You did. So you think this sell-off, particularly as it relates to those power stocks, was way overdone? Because they were all down, and all down a lot.
And it was a single great opportunity. It still is today. We added to not only Vistra, but the power area, the independent power producers that are generating cash flow, that can co-locate data centers, that have nuclear facilities. Okay, those are the ones to focus on.
What about the rest of the market? Are you happy with where we are? Do you feel opportunistic on where we're going?
Here's what we're talking to clients about. Stocks are at 22 times earnings against the backdrop of a strong economy, solid employment, declining inflation, and a Fed on hold. So the backdrop is strong. Yet stocks are expensive, and we're overweight large cap tech. So clients that have an allocation to equities of 40%, and it's now 50%, we're talking to them about trimming and moving that money into 4% tax-free bonds right now. So keeping a core allocation, but taking advantage of what's the opportunity is in municipal bonds.
But so you still like munis?
Yeah.
And you really think 50% of your portfolio in equities is too high right now?
Depends on the client. If a client is set up with an asset allocation of 50%, it goes up to 60%, it's time to discuss trimming it back. Now, that's not saying this could be one to get out of the opportunity of artificial intelligence. I mean, we have seen in the last 20 years everything from digitization to mobility to internet to mobile to the cloud, and now we're at the forefront of artificial intelligence. We're not looking to step off of that, okay? So it's important to keep a position in large cap technology, but look at the overall risk every client wants to take.
But you're making what is essentially a valuation call. So do you not, I mean, I get the idea that, well, you can't really have any more multiple expansion. I mean, how are you going to do that? Are you doubtful that earnings are going to be good enough to justify more moves higher, that sort of justify where the multiple currently is?
The earnings expectations are elevated, 14% growth this year and next year.
And you think that's too much?
I think the economy is doing very well. It's possible. But the decision to trim very slightly for clients is just simply, some clients really have a focus on the return of capital is more important than the return on the capital.
Well, that's because you have very, very wealthy clients. That's why, and you do well. That's why you're number 4 on the, I think you're number 4 on the top 100 financial advisors list last year for Barron's.
We have all sorts of clients. Thank you, though. And our job is to really align portfolios with their risk metrics and how much volatility they want to take.
What about the broadening story? Do you believe in it? Not so much. You just said the economy's strong.
Our overweight is in utilities and large cap tech. We do own a value component in our portfolios, but we're long-term holders of technology, and it has been amazing. It will continue to be amazing. Did
the Fed chair say anything yesterday that caught your eye, that said, you know what, that's important, I need to pay attention more to that?
No, the Fed actually is a big yawn right now, which is good. I don't think the market needs rate cuts to go higher. It needs earnings. That's the bouncing ball. Earnings and operating cash flow is what to follow. So the Fed could be on hold, and that, to me, is perfect.